So in this brief video, I'll be going through some of the problems at the end of Chapter 9, which involves tax credits. First one I'd like to go through is number 46 on page 949. Employment-related expenses paid by this couple was, using my data, which is altered, $8,000. The problem says $7,900. 3 kids, $1,800 reimbursed by the employer, and then maximum qualifying expenses for this couple is $6,500, and that information is given in the text. AGI of $57,000 earned equally by each of the spouses, so neither had an opportunity to stay at home to take care of the children. Based on their income, looking on the table on page 9-4, they're at the 20% of their qualifying expenses. So the credit then for this couple is calculated as $8,000 minus the $1,800 reimbursed by the employer, and then times their qualifying percentage of 20% is $940. 2 is a little different. Here we have just one income earner. That means he ostensibly the second spouse would be available to take care of the kids. Therefore, no credit is available for this couple for the children's expenses. Okay, and then let's move down then to a new learning objective. Let's try number 48. Goes to learning objective number 2. What is the AGI limit above which each of the following taxpayers would not be eligible to receive a credit for the elderly or the disabled? So this is a little bit different credit. I did not alter the data in this problem, and the reason I didn't is because we needed to use some algebra to calculate to get to the amount of the credit that's available, given the fact that given the data that's given, and the fact that they have some Social Security income. Now, first of all, we have to consider the non-taxable. If this were taxable Social Security income, we would not include it because they're already being taxed on it. But this is the non-taxable, and if you look in the text based on a single person for this credit for elderly or disabled, their baseline is $5,000. Their applicable limit is $5,000. So then I had to use algebra to solve for AGI, and I set the AGI to 0 so I could get everything on one side of the equation, the equal sign, the equality. Alright, so I set AGI to 0, and then I just calculated. I brought over the $5,000, took out the $1,000 of Social Security benefit that was non-taxable, and then this 1,000 I subtracted 0.5 times the AGI, which I'm solving for, minus 7,500. So because this involved algebra, I wanted just to lay this out for you. So solving then, continuing to solve the algebra problem here, 0 is 4,000 minus 0.5x minus 3750, which is half of 7,500. And then continuing the math, we have 0 is 7750 equals negative 5x. Move the 5x to the other side of the equality sign, and we have 0.5x is 7750. 7750 divided by 0.5 is like multiplying it by 2, and we wind up with x at 15,500. Alright, so that's the AGI limit for this couple. And then the others are solved similarly. Again, since this is a video, you can go play back and pause at various points to kind of work through some of the additional problems, but the method is pretty much the same. Down to number 50, learning objective number 3. This problem again is on page 9-50. Problem number 50, these are the education expenses and the education credit more particularly. We have modified AGI for a single person at 32.9. That's my information that I'm using. And as it turns out, that's consistent with the problem data. I did change, however, the education expenses for this freshman to $3,500. They gave education expenses of $3,400 for this freshman. So the amount of the American Opportunity Tax Credit, which we talked about in the PowerPoint video, is calculated as the minimum then of either the maximum of $2,500 or, and then we just calculate the $2,000 plus 25% of the difference between the education expenses and the $2,000 threshold. And it turns out that that $2,350 is the amount. That's the least. That's less than $2,500. Therefore, this is the amount of the American Opportunity Tax Credit that can be taken by this single taxpayer. I wanted to go to 53, and the others are calculated in the same way. Down to 53, this one I included because it demonstrates the phase out, at least a part of the educational expense credit. All right, so let's take a look. This is problem number 53 on page 9-51, and they give us quite a bit of data regarding the tuition and fees for the two semesters, fall of 2017 and spring of 2018, books and room and board. And then they give us more information. I've changed a little bit of the information for 2017. And all I did here was list all the data, all the information they gave us. Now what's interesting about this is because if you read in the text, you'll notice that the uncle was non-dependent, and therefore the amount received by the uncle is deemed as received and paid by the student. Therefore, I put check marks at the amount qualified, of the amount of fees that qualify for our calculation. Room and board does not qualify, so that one will not include. Okay, we're given these larger adjusted gross income amounts for this couple filing jointly. So the next question is, once we get the data in, that's kind of given to us, we need the net qualified education expenses. So what I did here then is I just included the amounts that are checked, that qualified expenses, and just added them together. 2,200 using my data, plus 1,000, plus 600, plus the 800. So those are the net qualified expenses. And then the pre-limitation American Opportunity Credit is the maximum we set of 2,500. However, they are going to have to phase out some of this credit because they're high income. So the way we calculate this, and it's demonstrated in the PowerPoint I went through as well as in the text, is we're going to take the pre-limitation credit of 2,500, and then we'll make any adjustments to that by the ratio or allocation. And that allocation then will take the maximum above which the credit is completely eliminated. The 180,000 subtract the taxpayer's AGI of 165,000, and then divide that by that $20,000 denominator or range. And that fraction then, this ratio up here, is multiplied right here. This ratio is multiplied by that 2,500. And this is the fraction then, this represents the fraction of the amount that they qualify of the 2,500. It turns out then when we carry out the math that their credit is reduced because their income is above the minimum in the phased out threshold range. Number 54 deals with the foreign tax. So here I changed both amounts that were given. We have foreign tax paid of $1,400, foreign income of $8,200 using my data, which is not the data given in the problem. Worldwide taxable income, $91,400 given in the problem, as well as a U.S. tax liability. So we're going to invoke that formula that we have in the text and we went through in the PowerPoint. And what we'll do first is we need to take the minimum of the $1,400 taxes paid, because we obviously can't get a credit for the amount greater than that we paid in the foreign tax. And then we're going to compare that to the foreign income divided by the worldwide taxable income, and then we'll multiply that by the U.S. tax liability, and that is less than 1,400, so that will be the amount. I'm sorry, that is greater than the 1,400, so that will be the amount then that we will include, because 1,400 is less than 2,064. So then they only qualify for the $1,400, the full $1,400 they will qualify of the foreign taxes paid. And that's nice because it means that they will not pay tax twice on the same income. I'll leave this up here so that you can pause the video and continue to calculate some of the other questions or parts of the question, and then you can look and use these as check figures once you change the amounts. This amount was not changed, so this is the check figure. If it's in purple, it's the actual data in the problem, as we've talked about. Okay, on then to number 55. Here we have, this is on the bottom of page 9-51. Here we're dealing with a child tax credit. We have three different scenarios. And I'm going to just run through the first one. I didn't change the data in the first one. Pretty straightforward calculation. Relatively low AGI for 2 kids for a single person. Amount of tax credit, presumably they don't say so, but we presume these children are under 17. $1,000 per child. So 2 times 1,000 is $2,000. Now I'm going to jump down. You can just run through part B, similar, but we have enough. Actually, maybe I'll go through this one because I like to just talk a little bit about the way this credit is calculated. It's a little different than other credits. So we have modified AGI of a single parent. In this case, I changed it to $80,000. Again, we have $1,000 per child. Now we're going to have the credit is $1,000, but it's reduced by any income over $75,000. And so what we'll have to do in this case is, first of all, we need to calculate the number of $50 reductions, and that's what's unique about this credit calculation, is that for each $1,000 there's a $50 reduction when the income exceeds the threshold of $75,000 in this case. And you have to round up. So if you have let's say you have 2.3 $50 reductions, in other words $50 for each $1,000 you're over the threshold, then you need to round up to the next one, which would be 3. In this case it would be 3 times 50. Using the numbers in the text, we have determined that the calculation is, we're going to take the modified AGI of 80,000 minus or deduct the threshold of 75,000 and then divide that by 1,000, and that equals 5. So we'll have 5 $50 reductions from the full credit. So they would have started with the 3 kids at $3,000, right? 3 children times $1,000 per, and from that 3 times $1,000 we're going to deduct 5 times 50, or 2,500, and we'll wind up with 2,750. So this is the way they phase out child tax credits. There are no AGI limits that apply in this case to the married couple with 1 child, so it's just 1 times 1,000. Alright, so that's the child tax credit, including an example of a phase-out of at least part of the credit. Over to number